Hello, everybody. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is September the 23rd. We're going to talk about what looks like a K-shaped housing recovery going on here. Part of the market's doing well, part of the market's not doing so well. It's confusing, it's conflicting, and of course, there's pros and cons to both sides. We see it in the media, we hear it in the reports and articles that are written, etc., etc. I'm Randy Patrick, your host, putting the realism back in real estate. We talk all things housing here. And if you're not already a subscriber, if you do me a great favor and honor and subscribe to my channel and help it grow, I would really appreciate that. So, having said that, let's get going. Okay, so the big news that came out the other day was National Association of Realtors, well, that's NAR, released their existing home information sales report for the month of August. And I pulled this up here. This is the Charles Dickens novel, A Tale of Two Cities. And, I look at this going, we got like a tale of two, I guess you could say, housing markets going here because, it was the best of times and it's the worst of times. And I think that's what's going on in our market right now. We have some markets that are performing wildly. Things are looking great. Sales are up. Home prices are rising. Yet on the other side, we have more and more people who are still suffering from forbearance, from pandemic issues, from delinquencies, from defaults. We have more foreclosure sales starting to hit the marketplace now, and you can see more filings going on and more sales, like foreclosure sales, creeping up on the calendar. So that's why it's very unique what's happening here. There's no right or wrong answer or theme or reason. I guess you just pick and choose where you want to go on that given market, essentially. So that's right. So we have a tale of two housing markets. As I said, one hand, there's a boom. Other hand, there is a brewing crisis. So it boils down to which one is going to prevail. It's almost like a wrestling match here. Which one's going to prevail over the next, 6 months, a year, etc. That will be determined. You think, I know you know where my perspective is, though, of course, people challenge that, and that's fine. You're entitled to your own opinion. So let's get into it right now. So ultimately, right, what we're talking about is NAR, as I mentioned, National Association of Realtors, released their existing home sales for the month of August 2020, and home sales jumped to a 14-year high as prices set another record. So all is well in existing homeland. You can see, again, sales of existing homes surged to a 14-year high. So we're basically getting this reporting going on constantly here. It's good news. Don't get me wrong. That's great for people to buy homes, to live in their homes, to enjoy their homes. That's what it's all about. And as long as you feel good about your purchase and it works for you, there's no complaint on my end, and we shouldn't be, judging or punishing people for that. Again, existing home sales at highest level in 14 years. So we're basically seeing, lots of activity, and whether this is pent-up frustration, this is maybe activity that could have happened a little earlier, a few months prior, that could have been even, maybe we'll say, more evenly distributed. We don't know because of some of the shutdowns that we had. Maybe this is all happening in a tight month. And again, I look at July and August traditionally being two very big months for home sales because we know what happens. You want to move in the summertime. You want to go and get your place all set up. You register your kids for the new school or whatever you're doing, and that sort of kicks off. Labor Day comes in, school starts, pretty much across the board for most places across the country. But August tends to be, July, August are the two really real top months for home sales that we've seen traditionally. So according to Mish Talk here, we're going to go over some of this, but the median home price. Let me just lean in here, guys, so don't worry here, so I can read this and print this piece out. But the median, existing home price, is up $300,000 to $310,000. That basically is what we're looking at, 11.4% increase from the previous year. Lumber issues, lumber prices are all-time highs, and that will affect housing prices and building as we go forward. Some of the lumber issues are going to, the pricing will be affected by the wildfires going on the West Coast in Oregon and California, etc. Inventory is tight. We're down to about 3.0 months of inventory. Again, the fire impact, especially that's what Lawrence Yun said, is the NAR chief economist, that we're going to see some issues with respect to, lack of lumber or supplies, which will drive prices up. New home builders will of course see that. as well as rehabbers and do-it-yourself home improvements. Those costs will go up. Sales time, because of low inventory and because of the low inventory, the low mortgage rates, people are clamoring to buy houses. So we're seeing that the average days on market of a home for sale decreased from 31 days the previous month to 22 days in August. And that just shows that things are going under contract a lot faster. So that's what we see out here. If I take a look at some of the sales breakdown, we've got for 3 straight months, home sales have climbed in every region compared to the previous month. Median home prices grew at double-digit rates in each of the 4 regions from a year ago. August 2020 saw existing home sales in the Northeast jump by 13.8%. All right. The median price was up 10.4% to $349,500. Existing home sales increased in the Midwest, 1.4% from the month. It's 9.3% from a year ago. Median price increased 10.7% to $246,000. The South saw a very nominal 0.8% rise, but it was up 13% from a year ago. The median price in the South was up to $269,000, which is 12% increase. And the West, again, inched up 0.08%, which was a 9.8% increase from a year ago. Median price was up 11.8%, $456,000. So we're seeing, again, as I said, double-digit price increases to average out to about 11.4% year-over-year price increases. So, again, the market is crazy. This is what NAR produces, so we'll run through this to help here. It's their summary of everything that goes on. So you can see that where the sales took a hit was, obviously February to March to April, and then it came sort of back up May to June to July. So this is the home sales seasonally adjusted annual rate. What NAR does, it calculates the sales volume on a monthly basis, extrapolates that on an annual. So we're just over the 6 million seasonally annual adjusted rate there. So, you can see that started off, we've been about in the mid 5s over the past little while. We have a little spike to just about 6 right now. So they think that's very bullish, and that's a good thing. Median home sales price, you can see that the median price has been, creeping up. We've had, it leveled off a bit, little peak, valley, peak, valley, peak, valley. It seems like every time we valley, the valley is getting higher and higher. You can certainly see that according to the chart. So we're at about 310,000 median price of existing homes. Realize that the median is right in the middle. It's not the average price. It's the middle point. So half the market is less, half the market is higher than the median. Median price is 310,000 as of August 2020. All right. The total existing home sales, a percent change year over year. So we can see if you follow the chart here, obviously the bar chart starts at the end of 2019, and we can see that it kind of got positive in December 2019, positive year-over-year sales, in January, positive in February, dipped in March, went negative. So we had less home sales in April, May, and June. Now, of course, once July hit, there was a rebound. So we've had an increase in July, increase of over 10% from the year over year for August. So that's promising with respect to housing activity, etc. Now, the existing home sales median price change, we could see that for the past year or so, that obviously August had the largest increase. It was over 11%, 11.4% year over year median price point changes. So here we go. Why is that happening? Well, we attribute it to lack of inventory. There's less homes for sale. There's more competition. We also attribute it to lower interest rates. So lower interest rates, of course, gives homeowners increased buying power, which allows them to spend a little more on their home and inch up maybe in the price point strata where they couldn't say 6 months ago or a year ago, etc. So it gives them more opportunity. So you can buy a bigger home and your mortgage is not as expensive as it would have been a little while ago. So you can spend more for your purchase. Your bang for buck is better with the mortgage. So again, the percent change in sales from price range. So when we take a look at what's going on here, so when we talk about affordable housing or lack of affordable housing, that really is the 0 to 250K range. So we can see, and this has been consistent for over a year now, that every month of NAR, National Association of Realtor sales reports, the $0 to $100,000 price range, there's less and less sales going on. from the previous year and the previous month, and the 100 to 250, we're seeing that happen as well too. So you got negative 20% growth in sales change for that segment, almost 9% negative growth for the 0 to 250K, which again is that segment is what I call affordable housing. Now we're going to 250 to 500K. The sales range was up 14%, 500 to 750, 28%, 750 to 1 million, almost 35%. 1 million above, the percent of change in sales was 44%. So you can see that the more expensive homes had the biggest change in sales volume on a year-to-year basis. Could that be attributed to either two things? Maybe there are more. I can tell you that there's more higher price homes in various locations of the country that are reducing their price. You can still be over $1 million. So maybe the home was 1.3, 2 months ago. Now it's 1.1. Now it makes sense for a buyer to purchase it. And oh, by the way, they're taking advantage of low interest rates, so it's a double whammy. So that now it's this is the best time for us to buy. Let's do it. So there's two things going on. The more expensive homes are becoming more attainable for various reasons to the buying public. It is kind of interesting. Sales price by range, or sales by price range, you can see again. It just breaks it out that the majority of the sales are happening in the 250 to 500K range. We're seeing 12% of the sales to 500 to 750K, 4% of the sales in the 750 to 1 million, 4% of the sales in the 1 million above. That's where I think we're seeing more dollar values hit. The 100 to 250K, 33% of the sales across the board, and the 0 to 100K is only 6%. So the lower end, not as many sales, as a percentage of the overall sales. The higher end, starting to take a bigger chunk of the pie, so to speak, with the pie chart here. Existing home sales by region: the South always, leads 43%. The Midwest always comes in second, 24%. West at 21%. The Northeast at 12%. So just the demographic and distribution of sales. More affordable things are in the South as opposed to the West and the Northeast. Midwest is kind of middle of the road, so you see more stuff going on in the South. And that, whether that's a factor of home buying, relocation, opportunities, we don't know. The South just seems to always lead the way in that respect. Now, housing supply. This is a concern, obviously. So the green line is condo co-op supply. The red line is single-family home. The blue line is the blended. So we can see that the condo supply is kind of static. The single-family homes are slowly dwindling, and therefore the blue line on the national overall month supply is on a negative trajectory as well too. So every month our national supply tends to decrease a little bit by little bit every time. All right, market conditions. To me, this shows where some of the buyer distribution is. First-time home buyers, there were more first-time home buyers than this time last year, so that's increased a bit there. Again, could that be to the fact that we've got better interest rates out there? It's attracting more people. Sales to investors are about the same, status quo. Cash sales were slightly lower by 1 point than the previous year. Distressed sales lower by 1 point. I always want to point out that distressed sales are short sale transactions, pre-foreclosures, before going to county auctions. That's short sales. And also, and that's also made up of REO, which is real estate owned, which are bank owned properties. They have been foreclosed on by the lender. They are put back into the market on the MLS, available to buyers. That is half, 1% as opposed to 2% of the marketplace, half of what it was the year before. What is going on now with the foreclosure sale, moratoria, and evictions as well too, and the lack of we'll call it foreclosure case or foreclosure deal, like just processing to get them to the sale. That's reflected here in the lack of distressed properties coming on the marketplace. And they also want to illustrate this month of the days on market. We see that this time last year it took about a property stayed on the market about a month, and now it's gone down to 22 days. So we're it's certainly it would be over 4 weeks, a little over 4 weeks. Now we're seeing it just over 3 weeks. So certainly shaving about maybe 25% off the time of the contract. And that is consummate with low inventory markets, and to me, this is not a surprise here. Low interest rates with low inventory markets are going to create people moving faster and wanting to get those homes under contract before they lose it. All right, we take a look at this is just the sales price region. They put this chart as well too, and you can see that the percent in change in sales, the first chart grid from a year ago. Go to the 1 million section, the bottom, the sort of the right-hand column. You can see that all throughout, from the Northeast, Midwest, South, and West, that the change in sales activity above the 1 million mark was pretty significant, and also above the 750K mark, pretty significant. And even if you take a look at it, look at the Midwest and South, that number was higher too. The Northeast and West tend to have higher priced properties on average, so you can see that their changes maybe weren't as high as the Midwest and the South, but for that mid tier. But in the end, you can see that the over a million certainly grew by 50, 60, 30%. So the average was 44%. Sales distribution, when you take a look at where the sales were, you can see that in the Northeast, most of the sales are happening in that mid tier. They had a little 5.5% in the 1 million. In the West, 11% in the sales, were on the 1 million plus tier, and obviously less of their sales were in the lower tiers, and that's just again price points. West Coast has much more higher priced properties, so yeah, you're going to see less on the low tier and more in the middle, and of course the higher tier they're going to show more as well too. The last chart they produce is change in inventory from a year ago. So basically, when you look across the board, from like the bottom, the bottom line that says U.S. across the board, we're losing inventory. So across the board, it's the segments are minus 35%, minus 23%, minus 13, minus 4, minus 2, minus 1.3. So obviously there's less change in inventory the higher the price points are. But where it's interesting to note that in the Northeast, they actually had an increase in inventory in the 750 range and the 1 million range. And the South had a very small negligible increase in the 1 million range. So that is indicative of the cost profiles of what's going on in that market. So obviously more people now are putting their house on the market that are higher priced. Maybe it's time to sell, or they want to relocate to the South. Who knows, right? But just notice that everybody else, every other region, every other price segment is losing inventory. And that one top right corner, so the $1 million plus strata for home pricing, actually saw just over 5% increase in, we'll call it inventory. So clearly, people are trying to move on their higher end or luxury properties. All right, so another housing boom. So as I said before, we've got part of the market that's an increase in value, showing strengthening, I guess you could say strengthening sales reports, sales numbers, the whole bit. Next week when Case-Shiller comes out, we'll see how that plays out. But again, Case-Shiller's drag along. It's not going to reflect this month. We know that the month of the month of August, we're seeing 11%, almost 10 to 11% increase in median home price. So values are rising, or the median price is rising across the board. How those values sort of work out, eventually we'll see in Case-Shiller on a per region basis. So people are saying, listen, we're in a housing boom right now. To me, it's no longer a boom. It's certainly in bubble territory. We'll prove it again with the Case-Shiller from where we were in the last bubble. You got to watch this though. This is where stuff happens. It's that false sense of security that things are going to keep going up and I can keep buying because I have undue pressure to buy properties in a competitive and low inventory environment, and I'm being incented to purchase with respect to low interest rates, that are given me by the Fed, which to me is a recipe for problems in the next little while. So my perspective too is that we're seeing the boom, but we're also seeing the bust. So the bust will continue, and we're seeing cracks in the marketplace, things that aren't quite manifesting themselves right now, but they're starting to. So this actually came out very interesting. Millions can't pay rent. Landlords making less than $50,000 a year are caught in the middle. And this is an article, obviously, on CNBC. I'll put the link in the information section of the video. But what it basically says is the fact that, residential landlords who make less than $50K a year get a bigger share of their income from rent than higher earners, according to this group called the Hamilton Project, who studied this. So this means that a tenant's inability to pay is going to have a much larger impact on such landlords who are also more likely than higher earners to have lost a job or employment during the recession. So sometimes these landlords, this could be their only opportunity to have income. So if they're losing rent and they're losing that income, and it will be a double whammy if they continue or need to pay a mortgage on that property as well too. So please realize that that actually can be somewhat problematic for people. And there is relief with respect to stimulus checks, unemployment, whatever, and that's great. But there is no, we'll call it hard fast rule that if you're getting a stimulus check or you're getting some sort of government support, that you need to be directing or giving a portion of that to your landlord. Because when the eviction moratorium was put into place, there was no proof point that said I can't pay my rent because of my job or income situation due to COVID-19. So therefore I need to have some protection for etc. So landlords don't get the protection, and renters don't have to declare where exactly their issues are from a financial perspective. So that's where we see that this could cause some pretty significant issues on a going forward basis. It says roughly a third of individual landlords who own residential property are from low to moderate income households with those incomes of less than $90,000 a year. So basically, such landlords derive a greater share of their income from their property rent relative to other people who own. That's the scoop. So essentially, the dynamic is concerned as millions of workers remain unemployed and may have trouble paying their rent from month to month, which may place disproportionate strain on ma and pa landlords, according to the director of the Hamilton Project who co-authored this analysis. And more than 8 million Americans hadn't paid last month's rent, according to a Census Bureau survey conducted by the end of August. About 77% reported loss of income or employment in their household. So 8 million Americans aren't paying rent. Now that's not all just to, mom and pop landlords. That's to multifamily corporations and other rent setups as well too. But the point though is that the market that's going to get hurt, that probably isn't manifesting itself at this exact moment, but will in the future, are the mom and pop landlords, the people that maybe are using this as retirement income or making ends meet. They're going to get to a point where they're going to go, I can't do this anymore. It's too stressful. I can't, I won't, or I'm paying a mortgage on to carry this property as well too. I'm not getting that rental income to help support that mortgage. So guess what's going to happen? I'm going to stop paying that mortgage, and that will be a trickle down or domino effect with respect to what's going to happen in the future next year. So you got to keep that in mind. So that's an example of the bust part of the market showing itself right now. We're not quite there yet. This I found very interesting, and I didn't get a chance to talk about this yet, but this illustrates what's going on. So this basically says, this is a Wall Street Journal article that came out a couple days ago, and 1 million mortgage borrowers fall through the COVID-19 safety net. Okay, and the reason being is that some homeowners don't know whether they qualify for a relief program that allows them to delay payments. So we'll call I won't say the word's interesting, but the uniqueness about the situation is that you will always have a segment of the population that's going to fall in this category. So there is potential solutions available to them, but for whatever reason, they don't know, they're not educated, they're not hearing about it, they're keeping their head in the sand, they don't want to face reality, they're not opening their mail, etc., etc. So there's a lot of reasons. Kind of like the last housing crisis, where a lot of people had no idea that there were government programs, lender programs, loan modifications available, the whole bit. Now, since that point in time, since the last housing crisis, one of the sort of laws or mandates that came out through all those issues was that the minute someone goes 30 days behind, the lender is compelled to send them out correspondence that says, hey, we see you falling behind. We've got loan or home solutions for you, which could be everything from foreclosure, deed in lieu foreclosure, short sale, loan modification workout program, forbearance, whatever. So they have those available, but it's one of those things where, the homeowner has to read it, the homeowner has to engage the lender to discuss the options and things like that. That's the way it works. But, I just want to point out here that, we've got, there's a significant amount of people here. So it's basically, it says here that, about 1.06 million borrowers are past due by at least 30 days on their mortgages and not in any forbearance program, according to Black Knight Finance Incorporated. Of those 1.06 million, some 680 have federally guaranteed mortgages and can qualify for forbearance plans. So, almost 70% of, 68%, almost 70% of this 1 million plus group here could contact their lender and could be given a forbearance program. All right, so that's great. The people who, of course, whose loans are not federally guaranteed, they, would have to contact their lenders to see what's available to them or for them, if anything. They're more exposed. And other than, housing counselors say many borrowers don't know that the forbearance option is available to them. Others are afraid of reaching out to their lenders. Others have trouble navigating the complex bureaucracy of mortgage finance. And I do understand that can be problematic for a lot of people just because that's what happens. It's not always easy. Everything is more, it's just not easy to pick up a phone and call your lender anymore. You got to go through the trees, the menus, go to the web first, do online chats. Like, in order to save costs and to be more streamlined, that might work well in the normal marketplace. But now with all this forbearance and pre-foreclosure volume, I can tell you that homeowners will get frustrated and they'll hang up before they find information or before they give themselves the ability for service. So now that's a good point here, which means what can we do with those homeowners? We as buyers, investors, whatever, we can reach out to the homeowners and offer them solutions. They may listen to us. We can purchase your house. We can do short sales. We can do things that are more creative that may be able to get them out of the bind or get them some equity and have them move on, etc. As opposed to the ultimate sacrifice or sad part about this process is losing their home at the foreclosure auction, where this is where a lot of these people are going to end up, unfortunately. So, it's just, and again, contradictory information. Early on, we heard lots of different stories and what lenders could or couldn't do. And so it was difficult to parse through this, and I can see people having, a lot of reservations and calling their lenders. So, the point, though, is that when we start taking a look at it, you got a lot of borrowers who are eligible, and they got to be in, they got to get into the programs. There's no other way. You can't force them in. They have to make the election themselves. Now, 250,000 of this, 6 million borrowers so far have been in forbearance, right? So even though we get weekly updates from Black Knight, it has something called this McDash Mortgage Monitor. They talk about active forbearances, so we're just under 4 million active forbearances right now. It kind of ebbs and flows on a weekly basis. The total number of people that were in forbearance or have been in the forbearance program are 6 million. So therefore, if we're at 6 million in totally, or we're at some point in time, around under 4 million left. We've got 2 million that either are, have got their problem solved, or out of forbearance, are into workout programs or loan mods, or the other part is they are delinquent, going to go down the foreclosure track. So there's 250,000 of the 6 million who were in forbearance at one point, but are again delinquent on their home. So for whatever reason, they were out of the forbearance program. They're delinquent. They're not back in. They're exposed. We're going to see more of that happening as well too. I guess you could say a survey of the National Housing Resource Center found that 56.6% of respondents didn't know about forbearance programs, and even a larger share of consumers were confused about their options, including 69.9%, who said they feared being required to make a large lump sum payment at the end of the forbearance period. And that's been, I think, the number one issue from my perspective, is the fact that there's been confusion on that. So the media, the sort of generic discussions are, hey, when your forbearance is over, we're going to put this lump sum at the back of your loan. You're not going to have to pay it or distribute over finances or your payments, and make it difficult for you. Now, that may be the case for certain lenders or servicing companies offering that to their homeowners. However, it still is based on the fact that the homeowner has to have the ability to pay. the homeowners has to have income that can be proved, so they can continue on with their mortgage and they can figure out where that money is going to go in some problem. If they can't continue with the mortgage, they don't have the income to support it. And as a side note here, unemployment income or stimulus income money is not considered, income, true income from the lender perspective. That's just either short-term or, government-based income. That's not considered, we'll call viable income or ongoing income that can be used to help with forbearance applications or loan modifications or things like that. So that's where people are probably, they're freaking out going, what do I do here? I don't have steady income. I can't, if I'm off for a year and that's, $15,000, $20,000, $30,000 of non-payment based on the size of my mortgage, I don't have that money. What am I going to do? So it's kind of a catch-22, which is kind of sad. But again, what I wanted to point out today is that, we are seeing high, median prices going up, sales volume going down, but price points going up and activity going up. Okay, so everything looks positive. A housing boom. Let's grow. Everything's great. Everything's rosy and wonderful. But there's still these signs here that just show us the dichotomy in this real estate market. So it really is kind of unique. But again, I'm not surprised, because it's almost like these are the last kind of things that happen when you're in a true bubble environment before things kind of break free. So that's my perspective on things right now. So I'll put the links for this stuff in the information section of the video. You can look at it if you'd like. And for me, my biggest takeaway is 1 million homeowners are not protected right now. So that was the Wall Street Journal thing. And to think about this, if 1 million distressed properties hit the housing market today, do you think that would actually make a difference in what's going on in our marketplace? That would be 1 million properties to choose from. Distressed properties would drive price points down. That would be great, and that would certainly help the marketplace and help a lot of buyers, enter into the market and have better priced homes to take a look at. And to be upfront with you, your property can be financially distressed, but not necessarily physically distressed. Now, it could be both, but these 1 million distressed properties, some of them can be perfectly livable, and a lot of them will be. They're just, it's the financial equation doesn't work for the homeowner. So that's the whole thing. We can solve that. You can solve that. We can solve that, and you can get into property if you know what you're doing. So that's my point here. So I talked about this briefly on my last video, and clearly you know what I do and what I want to do, and where the market's going to go from my perspective, and how you as a buyer or investor, whatever you want to do, need to kind of engage it to start looking at deals if you want better priced homes, because quite frankly, they're not going to just come to you easily on MLS, sitting there ready for you. It's competitive. People will pick those homes off faster than you can realize. You almost kind of have to take control of your housing search and your housing, we'll call it future, into your own hands, and I can certainly discuss that with you and help you do that. So we've got a new feature relationship that I think will help people in the distressed housing market. I do call it a game changer. It's going to work for both the homeowner, because everything that we do has to benefit the homeowner who's selling, who's in the situation. It'll work for the buyer, whether the buyer is a primary home buyer, yourself, or whether you're investing, or whether you're doing both. It doesn't matter. And it'll work for the real estate agent. So people who are earning commission on these transactions, it will help them as well to get stuff done, get access to homes, and do things like that. So if you'd like more information, basically you reach out to me, all right? I don't talk about it here. This is not a sales pitch. I don't like to disclose certain things that we're doing, or new opportunities in the public forum or on social media, just because, as I say, too many trolls, too many people wanting to take it out and engage it in ways that maybe it's not designed for. So call me, reach out to me. My information is right here. Send me an email, send me your phone so I can text you and call you and review this. It's really cool. We are in the process of implementing this right now, and the reason why I say that is because we're seeing more distressed property hit the market. When I mean distressed property, we're seeing more foreclosure filings pick up now, even though we're in moratoriums. Every time a moratorium is, we'll say, like where I'm in Florida, every time it's extended for a month or whatever, sometimes there's some subtle language changes that open things up a little bit here and there. Obviously, there still is the government moratorium and there's the CDC moratorium, but things, we're seeing more stuff change and open up. I see more foreclosure sale, sale dates being set now, and stuff that I'm looking at will certainly help get into that realm and help us acquire before that actually happens. That's where the inventory is, guys. It's before the foreclosure auction sale. So again, thank you for the views, likes, comments. Reach out to me. If you're not already a subscriber, please help my channel grow. Please and subscribe. I'd really appreciate that. Share the video with your family or friends. Again, call me, reach out to me. Let's get stuff moving out here. Time is now, the opportunities now, and as you can see, we're working two angles of the market. No reason why you can't buy cheap homes and resell them or fix them up for a profit. No reason why you can't buy cheap homes that you want to live in and enjoy. So there's a lot of opportunity here. Let's figure it out, guys.